Good morning, everybody. Thank you for joining us today. I am Charles Renner. I'm a partner with the Husch Blackwell law firm, and together with my colleague Purvi Shah and our entire team of Kansas City real estate and development and finance attorneys, we want to welcome you to joining us today. We're hopefully we're going to have a very good discussion that'll contribute to your perspective of what's going on out there. I will say one of my favorite quotes that I'll try not to butcher too much is if we know where we are and where we're tending, we'll have a better idea of what to do and how to do it. And this is probably one of the fastest changing environments that any of us have seen, not just from the health perspective, but obviously from the economic perspective. And so we're excited today. We're going to get some insights, kind of sliding through the overall metropolitan area economic aspects, some feedback from the lending community, and then some observations relative to just the pure real estate development and investment side as well. So we're very excited to have a great panel. Before we get started, I wanted to go through a few housekeeping items. At the bottom of your audience console are multiple application icons for your use during the program today, and I'd like to just take a minute to highlight a few of the key icons for you. If you have any questions during the webcast, please submit your question via the question box, and we anticipate having some time at the end of the webcast today to get some responses to those questions from our panelists. And if we run short, we will also find an opportunity to email responses to you, so you've got answers to the question you've got. There's also an icon to assist you with your viewing preferences. Please note that you can expand your slide area by clicking on the maximize icon on the top right of the slide area, or by dragging the bottom right corner of the slide area. If you have any technical difficulty, please click on the help icon. It has a question mark and provides information regarding some common technical issues. And a copy of today's slide deck is available in the resource list icon that looks like a folder at the bottom of your screen there. This program has been approved as well for Missouri CLE credit. So if that applies to you, you can download the certificate of attendance from the certificate widget at the completion of today's program. And in addition to that, a recording of the webcast will be available tomorrow for watching and sharing if that interests you as well. Once available, a link to the recording will be emailed to you, so you have that. And with that, we're very excited to be talking to you today about the current outlook for this current moment through 2020. In fact, we really are asking our panelists just to help us address two questions. From their perspective, what they are seeing with respect to the current economic situation in their industry, and then what expectations they have through the end of 2020. So we're hopefully going to be able to answer some of the questions you've got about this short-term outlook on a real-time basis. With that, I want to turn it over to my colleague Purvi Shah, who has a few comments before we get started. Purvi?
Yes, thanks, Charles. Welcome, everyone. Just wanted to say thank you again for joining us for today's webinar. I'm a senior counsel at Husch Blackwell in the Real Estate Development and Construction Group. Just wanted to introduce our speakers to you guys today, and also talk about, just touch base on, during the registration process, we had offered you the opportunity to answer a few questions about your experiences related to your back to work challenges. We had asked these same questions to a larger Husch Blackwell client group, and we're in the process of compiling all the information right now that we've received, and we should have full survey findings that will be available within the next week, and we will share them with this group. So look for that coming next week. Today we have three speakers for you. And we're pleased to have Jason Brown with the Federal Reserve Bank of Kansas City, Chase Powell with BMO Harris Bank, and Michael Berenbaum with the Lane 4 Property Group. Jason Brown is a Research and Policy Officer in the Economic Research Department of the Federal Reserve Bank of Kansas City. In this role, he coordinates the regional and commodities research of the bank and serves as a liaison to regional and commodities researchers located in branch offices and in Kansas City. He conducts research on issues related to regional economic growth, emerging industries, natural resource development, and structural change in regional industry and labor markets. Prior to joining the Federal Reserve Bank of Kansas City, Jason was an economist at the USDA Economic Research Service in Washington, D.C. He holds a PhD from Purdue University. Jason has also presented numerous times on the economic outlook at the regional, state, and district levels. Next, we have Chase Powell, who is a relationship manager for BMO Harris Bank's investor-owned commercial real estate group. He provides banking services to clients based in the Kansas City, St. Louis, and Denver markets, financing properties across the United States for those clients. Chase has provided commercial real estate financing of over $700 million while providing ancillary services such as deposit and treasury management services, syndication, and interest rate derivatives. Before joining BMO Harris Bank in 2015, Chase was a senior analyst in the capital markets group for MB Financial in Chicago, where he focused on underwriting sponsors, finance opportunities, including leveraged buyouts and recapitalizations, equity subscription lines, syndicated transactions, and real estate advisory services. Chase is originally from Lee Summit, Missouri, and received his bachelor's degree in finance as well as his MBA from the University of Missouri. Our final speaker is Michael Barenbaum, and he focuses on identifying and securing new investment opportunities as well as managing many of Lane 4's current assets. Michael has been involved in the acquisition and asset management of Lane 4 projects totaling well over $200 million and has played a large part in continuing to diversify the firm's portfolio. In addition to their retail portfolio, Lane 4 has invested heavily in other asset classes through both acquisition and development, including multifamily, senior living, hotel, industrial, office, and civic projects. Mike personally oversees many of Lane 4's multifamily and office properties and has been instrumental in several publicly partnered projects. Additionally, he has completed over $30 million in investment sales representing both buyers and sellers. He works to cultivate new equity and debt partners both nationally and locally in Kansas City. Michael's proven track record, combined with his experience and ability to secure investment opportunities, provides an ideal background for his role leading Lane 4's investment portfolios. Before joining the Lane 4 team, Michael served as Vice President of Asset Management for Lincoln Property Company in Chicago. So now we will turn it over to Jason to share what trends he is seeing at the Federal Reserve Bank. Jason?
Good morning, everyone. Thank you for the opportunity to speak with you this morning. My name is Jason Brown. I will be talking with you today just quickly about what we're currently seeing in the U.S. economy, a little bit, and what we were seeing in Kansas City metro area prior to this COVID-19 shock. I just want to remind everyone that these will be my views and not necessarily the views of the Federal Reserve Bank of Kansas City or the Federal Reserve System. So as we look in terms of the number of positive tests for our cases for COVID-19, what we've seen is what appears to be a leveling off. However, these numbers, as you might know, if you followed this, they can change as testing increases, and then we're also on the door of things being opened up again in the economy. The green line on the chart just simply shows a 14-day moving average, and so you can see there to the bottom right portion of the chart that the overall number of new daily cases at least appears to have leveled off as of now. The challenge, of course, with these stay-at-home orders is that while it's intended to flatten the curve, so to speak, in terms of the rising pace of the overall number of cases, that's led to quite a contraction in economic activity. As we look at GDP growth, which GDP, of course, is our broadest measure of economic activity, we saw that in the second half of 2019, growth was around 2%. However, in the first quarter of this year, we saw the Q1 come in at almost a negative 5% growth. The challenge that we're facing, though, is that second quarter is likely to be even more steep. Most tracking models right now put second quarter GDP growth at negative 36%. That number is unprecedented and unparalleled, at least in modern records of keeping GDP data going all the way back to before World War II. You can see, though, on the right portion of the chart what the forecasts are for overall growth for 2020 at minus almost 6%, but then expected somewhat of a rebound in 2021 at 4.7%. Some of our earliest indicators of how the economy is being affected is in the labor market. And labor market conditions certainly started to deteriorate significantly in March once these stay-at-home orders across the country went into effect. The chart on the left here shows unemployment initial claim filings. As people go to their local unemployment office and file online, you can see that in February and early March, we were averaging around 200,000 or a little more claims a week. That suddenly shot up in mid-March to over 3 million and then quickly approached almost 7 million. Since then, the numbers have come down each week, but they have remained elevated at over 3 million new filings in each of the past several weeks. Now, to try to put this in perspective, during the Great Recession in 2008 and 9, these weekly filings peaked at 500,000 claims. So the fact that we're seeing something in orders of magnitude higher just gives you a sense of the overall impact on the labor market of essentially putting the brakes on the economy by these stay-at-home orders. As a result, that's translated into a sharp decline in payroll employment, which is reflected on the chart on the right. This shows you changes in payroll employment measured in millions for March and April relative to February. And so you can see that as of the April payroll employment report, which came out earlier in this month, we've now lost over 21 million jobs. Most of those are in leisure and hospitality, but another bulk is in educational health, professional business services, and retail trade. As a result of this decline in employment and also increase in unemployment, consumer confidence is beginning to decline, as are measures of income and spending. So the chart here on the left shows different measures of consumer confidence, one from the Conference Board, another one from the University of Michigan survey. And you can see in particular the University of Michigan survey where they ask consumers or households their general view of economic conditions and their current status. You can see that there's been quite a sharp decline in consumer confidence. At the same time, we've seen some pretty sharp drops in consumer spending, as well as a real disposable income. That's reflected on the chart on the right. So this looks at month-to-month changes, and of course you can see in March there's quite a decline in both personal income and consumer spending. If we take a little bit of a step back from current activity falling, I could show you a number of other indicators that would show similar pictures of things falling, but I think these are good some good summary statistics. Keep in mind the consumer is 70% of GDP, so as the consumer goes, so goes the rest of the economy. It really has a very large influence on overall growth. But if we look a little bit closer to home and kind of think about what was going on in the Kansas City metropolitan area prior to COVID-19, this chart shows you payroll employment in Kansas City and in the U.S. overall, indexed to their level in March of 2018. And so you can see that much of the second half of 2018 and the early 2019, Kansas City Metro was growing up maybe a little bit slower compared to the rest of the nation. But then in the second half of 2019, the pace of payroll employment growth was largely the same in Kansas City as it was in the nation. You can see there's a small beginning of a step down there in March, but keep in mind, March data was collected prior to most of these stay-at-home orders really taking effect. And so those data don't fully capture the beginnings of the slowdown in the Kansas City metropolitan area. But if we go back a little bit further, this is the last thing I want to cover in my time with you. If we go back a little bit further in time, you can see that overall, Indianapolis, Kansas City, and St. Louis have had different, I would say, growth trajectories over the past year, over the past 10 years. So over the past 10 years, Indianapolis has grown faster than Kansas City, but Kansas City has grown faster than St. Louis. And so I want to talk a little bit about that because it has some implications for how various metropolitan areas might handle the current economic downturn and what things might look like going forward. So what could be one factor explaining the differences in growth in these metropolitan areas, which I sometimes refer to as the I-70 series? Well, one of the things that really comes about is thinking about how people in general are moving into and out of these respective metropolitan areas differently. And what we see over the past 10 years, or over the past closer to 18 years, honestly, is that Indianapolis has been more of a dynamic economy. Specifically, although I'm going to talk about population turnover here, similar things occur as we look at firm entry and exit into these economies. Population turnover here refers to simply the entry and exit rate of people. You can think of it as the churn of people, or how frequently people are moving in and out of these areas. Why we think about population turnover is because it can help us think about labor market adjustments, but also better matches between employer and employees. Those people move in and out of areas. They're not just moving within a metropolitan area, but across metropolitan areas. They're typically moving for employment reasons. And so as people move, they take their ideas with them to other places. They might find better matches. And so this adjustment is generally associated with longer-term growth in these areas. So if we look at the table towards the bottom of the chart, you can see that in Indianapolis, the population turnover rate in 2000 was 10%. That tells you that 10% of residents were moving in or out of Indianapolis in 2000. By 2017, that rate had increased to 11.5%. Similarly, in Kansas City, it went from 9.5 to 10.4%, and then in St. Louis, it actually declined over that 18-year period. So the fact that Indianapolis had experienced sustained increases in population turnover, meaning just the overall dynamics in the economy were higher, likely gives us a sense of why over a longer period, Indianapolis was able to grow faster. If I showed you measures of business turnover, of business entry and exit, it would look fairly similar. So with this in mind, obviously activity is falling. It's falling very rapidly, faster than we've ever seen it before. And there were some differences in growth profiles across urban areas before this, and so that will likely influence. So if I had to kind of continue on or extend what the implications might be for the population turnover, it could mean that Indianapolis will be able to advance out of this quicker relative to Kansas City, but perhaps Kansas City quicker relative to St. Louis. Of course, that all hinges and depends on what COVID cases will look like going forward, and also what, if any, resurgence might occur in the number of cases as these economies begin to open up again. So with that, I'm going to end here and turn it over to the next presenter.
Thanks, Jason. Now we'll turn it over to Chase at BMO Harris Bank to share what trends he's seeing at the bank.
Perfect. So first, thank you to the Husch Blackwell team for having me. I'm excited to be here and share BMO's perspective, and I hope everyone is staying safe and healthy. So I'm going to start with just a quick intro to BMO for those who might not be familiar, and help set the stage for our perspective, because I think as you talk to different banks of different sizes and who have different lending appetites, you'll get a little bit different perspective. So BMO Financial Group is the 8th largest bank in North America. We are active across all sectors with wealth management, capital markets, and personal and commercial banking. From a size perspective, we have a market cap that's relatively in line with peer banks such as US Bank, CIBC, and Fifth Third. So think smaller national banks and large regionals. And if you dig a bit further, BMO's commercial bank is divided into general commercial and further segmented into specialty groups like food and consumer and engineering and construction to provide diversification. And I'm part of one of those groups that focuses solely on investor-owned commercial real estate. And to dig a bit further into our commercial real estate group, we provide banking services across property types with generalists like me, and specialty groups for hotels, healthcare, and home builder, which we feel are more operational businesses than real estate. And you can see from the slide that going into the COVID pandemic, we were most active in apartments, industrial, office, and single credit tenant properties, with pretty limited exposure to hotels and retail, which was limited by design. And then active across all types of lending, but an important consideration is we're heavier in construction lending, with that making up about 40% of our real estate book. So, from there, jumping into how are we seeing in the current situation in our sector, and I'm going to jump into this by outlining a process that we put in place that has 3 general phases. Phase 1 was understanding the impact. So for our business, this meant the last couple weeks of March were spent touching base with all our clients, first and foremost making sure that they were all right, and then understanding what they're seeing in the market and determining impact. So throughout the bank, we identified industries that were going to be heavily impacted initially. And we also monitored how lending facilities and lines of credit were being used and drawn to understand the impact on liquidity. And I'm happy to report that we're in good shape there, but definitely a meaningful assessment up front as people drew up lines of credit and tried to access liquidity. So in commercial real estate, we quickly realized that our greatest impact was to hotels and retail. So we took quick action to basically run a bulk approval that would provide a structure for relief for hotels and provide some relief to those borrowers. And then we discussed options with our hotel clients based on the status of the property and what impact the client was seeing. We also set up trackers to understand any potential impact to our construction portfolio, such a meaningful part of our portfolio, and track modification requests. So, one of my key takeaways from this initial phase was I was encouraged when many of our clients talked about sharing in the solution. So they were listening to and understanding relief requests from their tenants, while also providing resources for government and other assistance programs, and understanding what cost-cutting measures tenants were putting in place. So landlords were not the only ones shouldering the burden, understanding that landlords and owners of real estate also have obligations, and it's kind of a trickle-down effect. And I think this helps to separate, true relief requests from some tenants who were potentially approaching the situation a bit opportunistically. And BMO has taken a very similar approach with our clients as they've reached out and potentially need relief. So phase two was planned for the future. So, at the same time, we were also understanding what term sheets we had signed and what deals we had in closing. And in our mind, it's important to honor executed term sheets. Those are not a commitment to lend, but we feel a moral obligation to honor those and support our clients. And through our conversations, saw that pretty broadly throughout the banking industry. And so from there, our primary consideration was pricing. And we basically had a twofold impact when the Fed made 2 off-cycle rate cuts and dropped their target rate materially. And then additionally, BMO and most banks also access capital markets for funding. And due to uncertainty, the cost of capital and our lending basis increased materially. So there was a period for about 2 weeks when we couldn't provide pricing guidance because things were so volatile, and that eventually settled down. And a lot of the discussions we had were updated pricing discussions with clients who had deals in closing, and we approached it with a mantra of no benefit, no harm to either party, just trying to make sure that pricing remained fair to the client and made sense for the bank. And the general outcome of that exercise was that really we saw all-in rates were not materially changed to what we were quoting pre-COVID, but the composition looked different, typically with a LIBOR floor in place that was lower than LIBOR previously, but with a wider spread. So that was a big part of our early discussions as well. And then we also recognize that there's more impact to come. So, first and foremost, it's a health crisis, and how that health impact moves forward determines economic impact. So we had early impact to hotels and retail, but we are monitoring some potential supply chain disruption and obtaining construction materials, and we're monitoring potential impact to office and apartment tenants as we get further into, stay-at-home orders and economic disruption. So phase 3 is determining how we move forward, and that's the phase that we're really currently in. So from a commercial real estate perspective, we've generally been a pause on new financing opportunities. And, for the past month or so, we've just seen very few new opportunities. They've started to trickle in the last week. But we have been considering a few, one-off deals for top clients. And, the transition has been that those discussions are happening directly with our senior leadership instead of the, twice weekly typical committee structure that we had in place previously. So at the highest level of the organization, BMO leadership established 3 guiding principles for how we move forward. The first is a focus on serving existing clients and key prospects. And so for commercial real estate, that is primarily a focus on existing clients. And, it's not due to liquidity pressure or availability of capital, but more that we want to partner with people who we know and with whom we have an operating history to navigate these highly uncertain times. The second guiding principle was to make sure all deals are priced appropriately for the new market, which I touched on previously. And the third guiding principle was to take prudent risk and avoid undue risk. So the nice thing about the initial portfolio review that we did in commercial real estate was that it showed us that we like where we have been playing. The vast majority of our portfolio is performing well, and we anticipate it will continue doing so. But how should we adjust how we have been lending to compensate for additional risk in this situation? So for us, that means a key to returning to meaningful new business is a major project for the commercial real estate team, where we form teams that focus on each property type. Each team is collecting market data, listening to webinars and reading materials from industry groups, collecting client feedback, and using our internal resources to determine anticipated impacts to each property type and underwriting guidance over the next 12 to 24 months. That project is ongoing and will wrap up by the end of May, but early indications are that this project will likely result in a more immediate return to financing for certain property types where we feel there's still strong fundamentals and they're going to be less impacted. Other property types will take more of a wait-and-see approach as we see how people return to work and we see how students return to school. And then there will be property types that we will likely be out of for a while because they did experience such a meaningful early disruption. So I'll stop there, but at the bottom of the slide, I did include a resource. So our capital markets group is putting out regular updates, and you can access those at the link on the slide. I think the most meaningful is they record our weekly calls, which are really interesting because the first 15 minutes is an update by Dr. John White, who's the Chief Medical Officer of WebMD, and he has a really nice approach of, updating where we stand and then taking an objective view of updates from the previous week and, what are positives, what are our negatives to returning to normal. So I will stop there and pass it to the next presenter. Thank you.
Thanks, Chase. As a reminder, if you guys have any questions, please submit those via the question box. We will have some time at the end that is allotted to answer any questions that the audience has. Now I will turn it over to Michael at Lane 4 Property Group to share what trends he's seeing.
Thank you, Purvi, and thank you, Charles, and everyone at Husch for hosting us here today and asking me to participate in this. Thank you also for doing this as slides only, because I confess it's been a minute since I've been able to get a haircut. Just going into the questions, the first question, what are we seeing? I want to break that down into the capital market side, our acquisitions, development, dispositions pipeline, and into asset management, the operations and performance on the property level. First, on the capital market side, we're seeing both partners on either side of transactions be pretty amenable to extending deals. This doesn't really require a lot of explanation why. Everybody's aware of the circumstances affecting everybody. On one deal that we're working on with Husch, we had a signed LOI in early March with a 60-day due diligence period. And the seller actually came back to us and said, why don't we make it 120 days? And that was an acknowledgement on their part that they would still like to get the deal done. We expressed that we would still like to get the deal done, and everybody realized that if we're going to do that, it was going to take a little bit more time. On some other deals, we have not been able to formally extend contracts for a variety of reasons, but have tried to maintain pretty open dialogue between buyers and sellers to hopefully re-engage once circumstances allow. On the property operations side, we have been pleased to see generally our portfolio, which is primarily Kansas City based, and the properties that are not here in Kansas City are within a couple hundred miles in Omaha and St. Louis and surrounding metros. We've been pleased to see collections do pretty well on the multifamily side. We have a property manager that nationally has over 160,000 units that sent out an update comparing their markets to other markets around the country, and Kansas City found itself right at the top of the list with collections in their multifamily portfolio sitting right around 96-97%, which is short of a normal month, but also not the crisis being experienced in some more heavily impacted markets. Same on the office side. Our collections are not quite a normal month, but are certainly short of a crisis at this point, and our teams continue to try to manage through that. On our retail portfolio, tenants have been more immediately impacted. And one thing I want to highlight in that area is the importance of the Paycheck Protection Program. I know a lot of the headlines that we've all seen about PPP have been focused on groups that receive funds that maybe didn't need them, and more recently on the complicated and evolving regulations that have some recipients scrambling to determine if they should return the funds that were received. However, in the context of what are we seeing, I think it's important to express just how critical of a lifeline this program has been to so many tenants across a range of different industries, and everybody from the mom and pops to the larger national and regional entities. We've had a number of tenants, and as we just heard from BMO, they do their best to quantify the need and make sure that people aren't just opportunistically, looking for the chance to pay a little less rent. And we're verifying financials and things like that, and can agree that a lot of these tenants really didn't have a lot of access to capital or revenue sources in order to pay rent, pay employees, and keep the lights on. And we had a number of tough negotiations turn around overnight as folks received their PPP and said, hey, your April rent's on the way, and we're going to be able to pay May as well. And so, we understand this is not a long-term solution, but in this circumstance where shelter-in-place orders have compelled businesses to close, it has been a key lifeline. And so I'll come back to this in a little bit when we talk about what we expect, but we feel like it's important that, the program get some of the issues wrinkled out. We all know it's not perfect, but that it's going to be critical if we face a second wave in the coming months or in the fall or whenever that may occur. Hopefully we avoid it, but if it does occur, I think it's going to be critical that we have the political will to continue to extend some lifeline in some form or fashion, as it was really important over the preceding weeks. The other thing we're seeing is the acceleration of trends, and there's a lot of good material that's been written on this, but a lot of trends that were in place in action before the crisis have been accelerated. We've all really grown in our ability to be productive and work remotely, and we believe that'll have lasting impacts on the office market. And on the retail side, grocery stores, restaurants, and other retailers have been compelled to further integrate their online operations and their delivery capabilities and the convenience that customers demand. Just thinking about restaurants and how quickly I've been able, and we've all been able to hopefully hit up some of our favorites and get some curbside service. Even when dining rooms open back up, I think that's something customers will continue to demand. It's a trend that had started before this crisis and was just put into warp speed here over the last couple of months. The trend for retail sales going online is obviously accelerating as well, but at Lane 4, we've long looked at that as a synergy between retailers' brick and mortar presences and their online presence, as the last mile logistics problems continue to be tricky to figure out. Retailers are more and more conscious of how they conveniently serve their customers by being at key spots in key corners in our markets. In terms of what we expect, our data here at Lane 4 isn't going to rival that of my counterpart here at the Fed, but we are cautiously optimistic that we have started a slow recovery. We've seen our tenants, even before shelter-in-place orders lift, slowly start to pick up sales. For example, we have a tenant with a number of locations that does haircuts, and they opened 17 locations in the last couple of weeks and have experienced good traffic. So in terms of staple consumer goods and necessary services, we see that hopefully bouncing back steadily, maybe not quickly, but steadily and heading in the right direction. And as I alluded to earlier, our big concern right now is the potential for a second wave here in the fall. We've thankfully been able to avoid abating tenants' rent in almost all situations, but we have deferred quite a bit of rent for tenants that necessitate it. And a lot of times those deals look like, 1 or 2 or 3 months of deferred rent or deferral of a portion of that rent, with those amounts starting to be repaid starting in July or towards the end of the year or into next year. And that has allowed us to defer losses, but we are concerned that if there's another shutdown, when tenants are supposed to be beginning to pay that back, that would compound issues and perhaps compel us to recognize losses as the deferrals at some point would become too much. The hole would become too deep to dig out of. And on the capital market side, we're keeping balls in the air, and hopefully, as we heard on the financing side, we're starting to see some activity trickle back into the market, and buyers and sellers start to figure out on what new terms a deal can get done. A key ingredient to that will be getting some competition in the market as more and more buyers come back, and there's more and more opportunities to create a little competition, and maybe that forces some action in the market. But for the time being, we are still seeing people pretty content to wait things out and wait for things to restabilize. Oh, look at that! I never even advanced my slide. That's my fancy data. But with that, I can hand it back to Purvi and Charles, and we can open up to a little bit of Q&A.
Thanks, Michael, and thank you everybody for walking through your perspectives. I think I'd like to start off, and Jason, his first slide really was talking about the COVID cases, and there's a pretty decent article called "The Hammer and the Dance," and to the extent that the shelter-in-place period has brought uncertainty, there's a pretty good argument of some uncertainty as we come out to this next stage. And as much as the COVID cases and that wave creates the cause for ups and downs in the economic cycle, I would think we'd anticipate seeing that uncertainty continue for quite a period. So I want to kind of pivot that into a positive type question. So from each of your perspectives, as much as the Kansas City Metro is experiencing very similar economic stress, what types of built-in strengths do you see the area having during the next uncertain wave period? And I'd say maybe an example of that may be that as much as the community's aspired to it, we still have a lack of dependence on density. And that may, in fact, be an advantage in a short period of time. But what I'd like to do is give each of you, Jason, and then Chase, and then Michael, a chance to share what observations you think may be, some built-in strengths for the area. Jason?
Yeah, so I think you've already touched on it, as it relates to population density and potentially any gaps that we thought might have occurred around healthcare infrastructure. It does seem in the Kansas City metro area that while we have had cases and continue to have cases, it seems that the system wasn't, overwhelmed by the sheer number of cases. And so I think in that regard, we can take some comfort from that. Now, that doesn't mean that other aspects of healthcare weren't challenged or haven't been challenged, because I think they have, as other services and procedures have been stopped or ceased these stay-at-home orders. So that's definitely the one thing I think we can take solace in. I think another is for those who have had the ability to work from home, and I recognize that is not necessarily the vast majority, but for those who have, it seems that the metro area's infrastructure has been able to handle that, or firms have been able to find solutions to allow their employees to continue to work. So we get a number of anecdotal information and reports from our various contacts across our region, but specifically also within Kansas City. And there's been a number of reports that folks have been able to adjust on that margin. Again, it doesn't mean there aren't challenges. It doesn't mean that it's been necessarily easy for people to work from home and maintain childcare for those where that's at play. But I think those are the two things I think that we can reflect on and think positively about.
Yeah, this is Chase. So I'll approach it kind of from a macro real estate perspective. And I think Jason had a really good slide in his presentation just showing, Kansas City as compared to some of our peer markets and, showing good, but, pretty measured population growth as we moved into this period. And so we looked at previous recessions, primarily the Great Recession, and what we saw with Kansas City, acknowledging that this recession is different, the systemic causes are different, but we've seen kind of slow, steady population growth from Kansas City for a number of years, and with that, we've had really smart and prolific developers that have kept our fundamentals in balance and are providing new supply as needed, but not oversupplying the market. So, from a real estate perspective, I think our steady population growth is good, and I think it positions us better than some markets where they've had somewhat explosive population growth, like Nashville, Austin, or Denver, and they might have large amounts of new supply coming into those markets, and that could be disrupted through this economic disruption. So I think we're well positioned there. And then just one data point on the industrial front is Kansas City has really good distribution infrastructure. It's a big distribution hub, and I think moving forward, our market will likely be the beneficiary of some trends that we're seeing in industrial distribution as companies look to, potentially bolster their inventories. And as we just see, maybe an accelerated growth of e-commerce. So I'll leave it there.
Yeah, this is Mike. I would echo everything that everyone just said. One additional factor is that we do not have an over-reliance on tourism that'll affect some other markets more dramatically. But I'd like to just quickly highlight one soft, maybe non-quantifiable factor that I think Kansas City has going for it. We're generally speaking a tight-knit community. We're very proud of our hometown, and we're polite, and so I hopefully think that will translate into people taking necessary precautions to find that balance between sheltering in place and opening up completely. We all know that both ends of both poles there are not going to be feasible. We've got to find that point in the middle where we can function but continue to stay safe. And so I think it's a responsibility for all of us in the community to be taking precautions and to set the tone in our organizations and in our communities that we all need to be doing our part, because I do have hope that Kansas City, because of some of the reasons that were laid out, has a chance to recover ahead of the national average. But the biggest factor in there, I think we all know, is how we do with this virus. And if we can keep a lid on that, I'm cautiously optimistic.
Thank you. So we do have an audience question that I would like to ask to Jason and Michael relating to the COVID-19 and ongoing economic and business impacts with the policy that the Kansas City, Missouri has implemented, and the difference between that versus the rest of the metro and what you guys see as being the economic and business impact for that moving forward with relation to the non-essential businesses.
I'll be happy to take a stab at that. We all know the complicated nature of the different government jurisdictions here in the Kansas City metro, and it can be a bit confusing as we juggle all the different regulations. I know we've been on the phone with a number of national retailers that their heads are spinning just figuring out when they can, not only when they can open in each area, but under what rules. Certainly not the most efficient way of doing it, but so long as our leaders can be nimble, we've already seen Mayor Lucas amend the 10-10-10 regulations. And, one of the benefits of having so many different ways of trying this is we'll have a lot of data and we'll see what's working and what's not working nationally. And I think we need to depend on our leadership to adapt, because I don't know that anybody can be certain that their rules and regulations are exactly right. They're all going to have to be adapted as circumstances dictate.
Yeah, this is Jason. I would just add to that. It is in fact the case that we are running a big natural experiment across the U.S. economy, because we just don't know. We just don't know how overall we're going to respond to this virus, or how this virus is going to continue to develop. And so as both state and local governments are taking different measures and different approaches, it will at some point allow us to go back and assess and try to look and test. Unfortunately, right now, we just don't know. So I applaud the comments and the efforts for a balanced approach, because I think that seems to be the most sensible, where we're trying to think about the safety of people, but at the same time, there's also people's safety being impacted by things being shut down. So definitely we should be thinking on both margins.
Thanks, Jason. I wanted to ask a question for Michael and then Chase to respond to, and it kind of relates to it's more of a construction focused question. The Kansas City area has got, I think, a unique economic link to the construction industry, not just because of the amount of construction jobs that are tied to the to work in the metro, but also just we've got, whether it's general contracting, engineering, architecture firms. There's a lot of Kansas City jobs that are working on building in the rest of the country. So there's a double benefit and a double burden there. You had both mentioned in different contexts a pause in new, and in a number of the prior recessions we've had, usually the last tail has been fall off on construction pipeline, just because of the general contractors being in a position to complete the pipelines they're in before that downturn happens. And that's not been the case here. There's been a quick fall off on pipeline and in the construction industry. So the question is for that, what type of indicators or factors are you anticipating looking for to start being in a position where, either for Michael, you're looking at new projects that you may be undertaking, whatever category they are, or chase when you would start looking outside of like the current customer base and new project development? Really from a what's gonna you're the customers on the construction side. What do you think will start generating that interest? I'll let Michael, you go first.
Sure. Well, we've got increased risk on one side and lower interest rates and potentially lower construction prices on the other side. So that's actually something that we are actively working on right now with one of our general contracting partners on a project that was pretty far along going into this thing. As we look at, hey, do we wait a year and hope that things stabilize, or is there going to be a good opportunity in the construction market to build a project for some amount less than it would have cost before? We all know that labor has been a primary driver of the inflation of construction prices. And frankly, I'm very interested to see what kind of feedback we get from our general contractor. So when we look at the increased risk and we layer on lower interest rates and hopefully some lower construction costs, we'll put some of these deals to the test and see if we can't get them going here before the end of the year. And if not, we'll do what we do. We'll try again next year.
Yeah, and I agree with Michael's comments. Across the board, as we've talked to our clients, they are reporting that general contractors and subcontractors have been very busy. They're fully staffed, and they want to keep their crews working, and that has actually cultivated, more of a competitive environment in that community. And so, for projects that maybe they priced in the past 3 to 6 months, they're going back through a repricing exercise as they're, stack ranking those projects to move forward, and actually seeing some cost savings. And the amounts have ranged pretty wildly. But definitely that's been a positive, and I think will help keep new supply up. So certainly pipelines, and we have an engineering and construction group, and so they're always looking at, who are the general contractors that we're financing. They tend to know their pipelines, 6 to 12 months out, even 18 months, and so they're keeping a close eye on that. But I think we will, especially in the short term, see a general pause. But then there will be some industries that emerge from this and have demand. A big area where we're seeing it is just on the industrial build-to-suit side, where retailers or e-commerce players or consumer products are trying to patch immediate holes in their supply chain. And so where we've seen speculative development fall off, we've actually seen a big increase in build-to-suit. So it's hard to tell where the kind of supply-demand will shake out. But agree, financing costs for the time being still seem reasonable, and it seems like there's still infrastructure and companies who want to work. So I think it's generally positive.
Great, thank you. And I want to say thank you to everybody for giving us some time today, and particularly thank our speakers for being willing to give us their thoughtful perspectives on what is the fastest moving cycle I think any of us have ever seen. There's a lot of similarities that we can draw from experiences on, and Jason, you did a great job of helping us with the context there. And there's a lot of things to consider as we move forward, and we've got some very good perspectives on that. So I appreciate the input and the discussion, and certainly everybody giving us their time. If you've not had a chance already, it'd be great if you could click on the survey icon at the bottom of your screen and complete the short survey. as much as we value the feedback from the panelists, we certainly value your feedback so we can add to the information that we're giving you as we go forward. And as a reminder, this program has been approved for Missouri CLE credit. So to the extent that that applies to you, you can download the certificate of attendance from the certificate widget at the completion of the program today. And the recording of the webcast will be available tomorrow for watching and sharing. And once it's available, a link will be sent to you via email. So once again, on behalf of Purvi and myself and the entire Husch team, we appreciate your time, and this concludes our webinar. Thank you very much.